All right. Well, hello, everybody. Happy Monday afternoon. We're going to give folks just a few more seconds here to load up to the call. And while they're doing that, I just want to welcome everyone to today's market update. I'm Greg Patterson, and I am joined with my teammates, J.A. Kennedy, Tara Gould, and Jen Mann, and we are with Atlantic Wealth Management here in beautiful Morehead City. And this is our mid-year 2025 market and economic update. And we're so glad that you have joined us today. We have got 35 minutes of action-packed, fun stuff to talk about today. And each quarter, we strive to bring you the latest on markets, the economy, our thoughts about where we're headed, and all these fun things. We hope that these virtual meetings are a chance for you and your loved ones to tune in and hear our thoughts on these things. And we host these calls every quarter. So our last one was in April, right around the time of tariffs, when that all started. Our next one is going to be Monday, October 27th. And these are always held at 4 o'clock on that last Monday of the quarter. So we invite you guys to tune into these and also forward the invitation to friends and family that you think might benefit from these updates. And we also try to post these to our website as quick as we can once we get compliance approval. So this allows you to go to our website and view the content on demand as often as you like, and also to share with others as you see fit. We ask you to do this because it helps us reach those who you care about and may be beneficial to them, and they may find value in the work that we do. So should you have any questions or feedback from today's webinar, we ask that you email us, and you can actually do that during the webinar to Mackenzie@myatlanticwealth.com. Mackenzie is how you spell her name, or you can always call us here at the office, 252-515-7800. We always appreciate your questions and look forward to your feedback. So with that, we've got an agenda of what we'll discuss today. We want to go over how the markets are performing mid-year, and Tara's going to take us through that. We're going to talk through the 2025 economic data. So we're in the second quarter, and we've got a lot of economic data to go over with you. JA is going to be giving that update. The key components of the One Big Beautiful Bill Act, we're going to go over and share our insights on that. And lastly, we'll have some actionable items and some takeaways from our time together today that you can implement to improve your financial situation. And then, of course, we always share some biblical wisdom at the end and give our conclusions to the call. So with that, I think everybody's loaded up to the call, and we can go ahead and get started. Tara, you want to talk us through what markets have been up to these days and give us a year-to-date synopsis?
Of course. We're going to go through market updates similarly to we have in the past, but it's always fun to talk about markets, especially at these times. And so what I want to do today is a couple different snapshots. First, we're going to take a look at S&P 500. We'll look at smaller cap, Russell 2000, and then we'll end on NASDAQ. I wanted to look at both year to date. So we're using kind of a smaller time frame for returns. We're going to look at year to date as well as from a 2025 market low. We'll be looking at those as well. So for S&P 500, remember, we like to talk about this each time, just as a reminder that the S&P 500 is the largest publicly traded stocks in the US. It's just a really good indicator of the overall market. If you remember, way back in January 2nd to be exact, we started the year, the index was trading around 5,800 points. And I took this snapshot from earlier today. I think I looked just as we were hopping on, the market had dropped a little bit, but we're trading in that 6,300 range currently. So what we're looking at year to date is between an 8 and 9% rate of return. We'll talk a little bit about the lows. Jay, go ahead and go to the next one, the next slide. So I wanted to show this for a couple reasons, is just to show the resilience of the market, and also to reiterate, if, you've ever had the question of, should I say invested or, should I not? There's a lot of factors in that, but when it comes to looking at the market, I like to show these, dip points, and what it looks like when we rebound. And if you guys remember, this happened really quickly. So what we're looking at on the S&P 500 is we're looking in early April. So we had the market dip down, and so close of market on April 8th was around 4,900, right up under 5,000. And so if you compare that to where we are today, from that low in April to today, that's a 28% increase. And so we're not saying, you had to time the market exactly. I mean, if you put money in the market in April, that was a very good decision, but a 28% increase just in those, 3.5, 4 months. And so what was happening in April, just a few other things, Jay, you're fine to leave right there, is just the discussion around tariffs, and tariff fears, but we can see that that quickly rebounded once that settled out. And then next up, we have the Russell 2000. So remember, S&P 500, we're talking about those large companies. Russell 2000 is smaller companies. And when we think about the makeup of the Russell 2000, it's more heavily weighted on industrials and healthcare versus like the S&P 500. What is it heavily weighted in? Is more on the tech side. So you can see just year to date, we have an increase in the market of right up under 2%. We did start the year, small caps were lagging. So these are going to be those smaller companies. And then, of course, they were impacted in a similar way in April. Okay, you can go ahead and go to the next slide. And we had a similar dip in April. So April 8th was the low on the Russell 2000 as well. And since then, so we were trading at that time at 1,760, and now we're over 2,200 points. So that's a significant gain on the Russell 2000 as well. What, 28%, I think I calculated. And then next is the NASDAQ Composite. A lot of people like tracking this index. It does include over 3,000 companies. This is a heavy emphasis on tech and growth sectors. So while we've seen increases in, of course, performance, we've also seen volatility. So we started the year NASDAQ around 19,000 points, just to give you a little bit of perspective. And we're trading today above 21,000. So that's a year-to-date change of 9, almost 10%. That's awesome. And then another snapshot. So in early April, this index actually fell into the 15,000 range. So that was a significant decline. And if we look at where we were in April to where we are today, the index has increased about 38%. So again, another really powerful rebound, and this is tech-led just in the past 3.5, 4 months.
Thank you, Tara.
Of course.
Good afternoon, everybody. On these regular update calls, we like to kind of go through a general overview of economic conditions. And so have a graphic here. I'll just kind of go around the horn, so to speak, on each of these issues or each of these topics. At the top there is just consumer spending. And so really when it comes to the health of the economy, consumers make up about 70% of economic growth and spending. So when we look at how is the consumer doing currently, the consumer has been pretty strong and pretty resilient. We can measure several things with that, but if we just look at like retail sales year over year, We're up just under 4%, so 3.9% on retail sales year over year. That's one measurement point. But we see the consumer as having been resilient, and we don't see any red flags there at this point in time. Going around to employment, we have continued to grow jobs. Things have been up and down a little bit in terms of the monthly jobs reports, but we ticked down in the unemployment rate just slightly in the last report, from 4.2% went down to 4.1%. And we would say that that's a relatively healthy level historically. Personal income, this goes back to the consumer, but we can, if we measure just a year ago, personal income for consumers on the average is up 4.3%. So if you compare that to the retail sales number, right around that 4% number, we're continuing to grow both income and spending. Becomes alarming if we see spending increase without income, right? So that bodes well between income and spending. And then manufacturing. If we look at just the ISM manufacturing index over the last few months, we have had somewhat of a decrease. So I think we need some more time to determine whether or not that's maybe temporary due to uncertainty over trade situation, or if that's a larger, longer term trend. But that's something that we pay attention to on a monthly basis. From a housing standpoint, this is somewhat of a mixed bag. We have seen that new home sales are down a little bit year over year. So if we look back a year ago, existing home sales and housing starts are pretty unchanged from a year ago. So we have seen somewhat of a cooling off in the real estate market. Rates are still higher from a mortgage rate standpoint. We don't see a major crash, but I think it's to be expected that we couldn't continue to go up and up and up in the real estate market like we had done for quite some time. And then GDP, this is gross domestic product, or overall economic output of the US economy. And we finished up the second quarter, obviously the end of June. We've got the first report or estimate of GDP growth for the second quarter that will come out in a couple of days. So there's forecasts out there currently. Consensus seems to be that we'll see a number around 2.4% annualized growth, which we would say historically that's a positive growth rate for the economy. But there's some range in estimates. Some are up over 3%, some are under 2%. So we'll know that fairly shortly. I think it is worth noting we had the first quarter number was negative, slightly negative for GDP. It was negative 0.5%. So some of that was front running on tariffs, where there was talk of tariffs and a lot of imports came in the first quarter that impacted that GDP number. So yes, GDP is going to be higher for the second quarter, but I think we have to kind of look at the two quarters in tandem, first quarter and second quarter, as first quarter being a little bit lower than normal, other things being equal, and vice versa on the second quarter. And then we've got in the middle there inflation. So that's been the backdrop of things really over the last several years when it comes to the economy and interest rates. And that is still the case. We do see that we've been able to maintain between 2% and 3% on the rate of inflation when we measure it from the Consumer Price Index, the CPI. It is at 2.7% was the last monthly number. So that's higher to 3% than 2%, which has been a communicated Fed target. So we will see about what interest rates look like, how the Fed responds to economic conditions and to inflation. They do meet this week. There's about the market thinks is a 93%, 94% chance that we see no change in rates. So that's the likely scenario this week. But we do see there's about a 62% chance of a rate decrease, a quarter point decrease in September, and a 42% in December. That's just a snapshot of forecasts currently. So things can definitely change. I think the Fed has shown that they're committed to paying attention to what is going on in the economy, what's the current data suggesting, and then making a decision accordingly. But that's kind of where we are from a overall economic snapshot standpoint today.
They call that data driven, right, Jay?
That's right. That's the term, data driven.
Excellent. Well, many of you, I'm sure, have been paying attention to the news and have seen the news of the One Big Beautiful Bill Act that was passed into law on July 4th of this year. It contains a lot of pages, and in fact, I figured we could go over the 1,000 pages today, but Jay reminded me we didn't have that much time. So we're going to cover just a few provisions that we thought would be important to note, especially for investors. And that's going to be centered around permanent extensions of the tax law TCJA that was in 2017 and an impacted taxes beginning in 2018. We're going to talk about the temporary deductions as well as changes to itemized deductions. There's some good news there too. And estate tax exemptions, we're going to go over good news there, as well as Trump accounts. And this bill really focused on cutting taxes, scaling back federal entitlement spending, and expanding personal savings options. I believe there's some debate on that. The Tax Foundation, which is America's leading nonpartisan educational tax policy nonprofit, says, and I quote, "While the tax law is expected to grow the U.S. economy by making pro-growth policies like 100% bonus depreciation and research and development expensing permanent, it misses an opportunity to address the growing deficit and focuses too heavily on political carve-outs like the no tax on exemptions that further complicate the tax code." The Tax Foundation does estimate that the tax law will increase long-run GDP by 1.2%. So as a team, our ears perked up on that. But it also increases the deficit by $3 trillion over the next decade when factoring in spending cuts and economic growth. So this came out of the budget reconciliation process and is something that I think we all need to pay some attention to. So let's just start with permanent extensions. This is centered around the 2026 tax brackets. So what you're looking at here are the tax brackets, both on the left-hand side from the TCJA. Again, this was the current tax law, and the OBBBA. So the changes there for single filers. The actual brackets themselves on the far left-hand column stay the same. The numbers are indexed for inflation on the new bill, and you can see those in green. So for example, if you're making taxable income in the $210,000 range, you're still in the 32% bracket. This basically has had no change to you going forward. However, it does make those cuts from 2017 law permanent, and that's good news. It takes some of the uncertainty away from that tax policy and what was going to happen. So I would say the end of these adjustments would be to slightly reduce effective tax rates for most households by having more income tax in the lowest two brackets. But I don't think the change is going to be large enough to make a noticeable difference in total taxes paid. This is looking at married filing jointly. So if your tax filing status, you're married, you file jointly. You can see again the indexing for inflation on the right-hand side under the new bill. So there is a little bit of change there, but not much. Again, it just makes it permanent. So I think that's good. Next, we're going to look at permanent extensions based on the estimated, this would be standard deductions. So this is the new bill versus the old law from TCJA. So there is some change here. The big change for this is if you're 65 and older. We'll talk about that in a minute, but married filing jointly, your standard deduction under 65 is $31,500. And again, that's just retained permanently. And then we can go to the next slide.
Yeah,
Jen, I think you're going to talk us through this.
that's me. Hi, everybody. So the One Big Beautiful Bill Act does establish temporary deductions for overtime pay and tip income, subject to certain limits. So this was talked about quite a bit before the law was passed. But tip income is deductible up to a limit of $25,000 annually per individual, regardless of the total amount of tip income received. As far as overtime, qualified overtime compensation is deductible up to a limit of $12,500 for single filers and $25,000 for joint filers. Both the deductions for tip income as well as overtime pay are subject to a phase-out based on modified adjusted gross income, beginning at $150,000 for single filers and $300,000 for joint filers. Both deductions are also considered temporary, and as of right now, they're set to expire in 2028.
So it's not unlimited,
Right.
but there is
Yeah,
some deduction.
for now.
Mhm.
And then moving on, this was another one we heard a lot about. So the Big Beautiful Bill also introduces a new tax deduction. It's going to allow filers to deduct up to $10,000 in qualified automobile loan interest annually. Now, the vehicle must be for personal use and it must be assembled in the United States to qualify. And the loan must have been taken out after December 31st, 2024. Used vehicles don't qualify in this case. Currently, this deduction, this is another one available from 2025 to 2028, and it does phase out for clients with modified adjusted gross incomes of $100,000 for single filers and $200,000 for joint filers. So no used cars, but new cars for a few years anyways. You might be in luck.
All right, I'll take over here. So the new law creates some additional temporary deductions, and this is going to be for seniors age 65 or older. The same time frame, so this is going to be 2025 through 2028. I think a lot of people, when they initially heard this, were really excited. The new deduction is at $6,000 or of course $12,000 if you're a joint filer. If both spouses are 65 or older. Keep in mind that this is a deduction that has income phase out limits as well. But one thing to note is whether you are itemizing or taking the standard deduction, the age 65 plus deduction is available to you. There we go. Little pause there. One thing with that, I wanted to highlight, just because I've heard some people talking about Social Security income is not going to be taxed, or something along those lines. Just to reiterate that the One Big Beautiful Bill Act, it does not eliminate the taxation of Social Security income. I actually read that there was an email sent by Social Security Administration that claims the new law would result in about 90%, 88 to 90% of Social Security beneficiaries owing no tax on their benefits. And I think there was also something put out the White House. But just keeping in mind that what they're referring to here is this new temporary $6,000 deduction. Here it says a 65-year-old who has not claimed benefits gets the same deduction as one. The deduction helps from an income standpoint, but it's not specifically targeting Social Security income. And so in practice, what this looks like is, yes, it's going to offset some income for those who are eligible, but the deduction doesn't directly tie to Social Security benefits. I think a lot of people are just thinking that, okay, because of age and maybe I'm taking Social Security benefit. So I just wanted to make sure to clarify that.
Thank you, Tara.
First.
I meant to bring up too, long-term capital gains on realized
Mhm.
long-term capital gains. There was a slight movement in that for the 0% capital gain on married filing jointly. It was at 96,700 taxable income. So if you were below that and you had some capital gain income that was realized, that would be 0%. It's gone up to 98,196 under the Big Beautiful Bill Act. So it's about $1,500 difference to the better or to the higher. So where that can come into play, maybe on a being retired and not taking out Social Security income yet. So you've just newly retired and you realize some capital gain income, you're married filing jointly, perhaps you can stay under that 98,196 taxable income and get it for 0% tax, which is always nice. There's several of these changes to itemized deductions. We're not going to camp out on all of them. What I would like to point out is state and local taxes, also known as SALT. The TCJA rules are on the left and the Big Beautiful Bill are on the right. So the cap is increased to 40,000 for this year, 2025, going forward. And it adds 1% a year to 2029 with phase outs at 500,000 adjusted gross income. It does revert to 10,000 as the cap in 2030. So we've got some time, 5 years, let's say, before it reverts back. And if you remember, prior to TCJA, there was no cap on the SALT tax deduction. So taxpayers could effectively deduct 100% of their state and local taxes paid. When this came out, it definitely created a windstorm of controversy, even including states that sued the Treasury Department and the IRS. But it was ruled constitutional. So, it's nice to see that get a little bit larger on the cap. So this would be important, if you had property taxes, maybe you own multiple rental properties, or you had some not so much rental properties, but personal property where you could get above that $10,000 cap. Mortgage interest, it adds mortgage insurance premiums as deductible. That's the one new thing there. And then miscellaneous itemized deductions. It permanently disallows unreimbursed educator expenses, possibly added as a deduction. So there are some interesting things there. And then gifts to charity. There's an update there, reduced by 0.5% of adjusted gross income if capital gain property also donated. So there's some different wrinkles to it as well. Tara, I think you're going to talk about, or maybe no, this is Jen.
It's Jen. Yeah, Jen's going to cover that.
Yeah. All right, so the bill also provides for some enhanced estate and legacy planning benefits. So as it relates to the estate tax exemption, the bill raises it to $15 million per person or $30 million per couple, and that begins in 2026, with further inflation adjustments thereafter. So that obviously provides relief for families who might have estates over $15 million, who would have otherwise faced an estate tax of up to 40% of any excess. As is the case with the estate tax exemption, the lifetime gifting exemption is also increased to $15 million per person, $30 million for married couples, again, beginning in 2026. So the increase in both the lifetime and the estate exemptions, it really gives taxpayers more flexibility when it comes to deciding whether or not to gift while they're living, or perhaps to wait until they're passing to take advantage of things like step up in basis, anything else along those lines. Also, regarding 529 plans, we chat with a lot of you about 529 plans for kids and grandkids. The bill expands the types of expenses that are eligible for tax-free distributions from 529 plans by essentially broadening the definition of what they refer to as qualified higher education expenses. So there are two specific items to note here. As far as K through 12 eligible expenses, it will not only include tuition, but also certain curriculum materials, textbooks, things like tutoring services, standardized test fees, dual enrollment fees, maybe for some of the older K through 12 students, and even some educational therapy costs for disabled students. And then for K through 12 expenses, the annual limit for tax-free withdrawals, it actually increases from $10,000 to $20,000 per beneficiary, again, beginning in 2026. Also, and this is pretty cool, qualified post-secondary credentialing, licensing, and apprenticeship expenses may also now be covered. And this would include tuition and fees, books, supplies, equipment, exam fees, and even continuing education fees required to maintain the credential or license going forward. I read that even in our business, things like certified financial planner designations, like we all have on this call, it could even be used for continuing education for things like that. So pretty neat. And finally, Greg mentioned in the previous slide changes to itemized deductions related to gifts to charity. But one additional below the line deduction worth noting, the law does provide for a deduction for charitable contributions for taxpayers who take the standard deduction of up to $1,000 for single filers and $2,000 for joint filers. And again, that begins in 2026.
All right. So also in 2026, so as of July, it's supposed to be a year after the bill's enactment. This is called Trump account, or I've heard it called Trump baby account. And so what this account is going to allow is contributions. Right now it's set at 5,000, but this is going to be indexed to inflation in years after 2026. They can be made to this account on behalf of a beneficiary. The rule is the beneficiary cannot have reached age 18. A couple things I want to point out here, keeping in mind that I know we're going to hear some more information in regards to clarification, because there's a lot of questions about this account and how things are going to look, especially once the child reaches age 18. But I want to put it on your radar. So unlike a traditional IRA or a Roth IRA, you may have talked to your kids, your grandkids, about starting one, but there has to be some sort of earned income in order to contribute to those types of accounts. This account specifically states there is no such requirement. So contributions can be made directly by a parent, an individual. There's also some verbiage in there from other types of organizations or institutions can contribute to this account, but they are not tax deductible. And so putting money into the account, another thing to note here is there's what they're calling a pilot program, which I think is really interesting. And so this pilot program is supposed to jumpstart the contributions into this account. And the pilot program is in which the parents can elect to have $1,000 credit paid to the account, and this is by the government into the Trump account on behalf of the eligible child. Eligible child is defined as any U.S. citizen born 25, 26, or 2027. So also interested to see logistically how that works. But if you guys look in year 18, this is where a lot of the questions come from, is when the beneficiary reaches age 18, we view the account to start to look more like a standard or traditional IRA. And it's going to be a mix of after-tax dollars as well as, maybe some pre-tax contributions from other sources, if they're going to allow rollovers and things like that. So I want to, again, put it on your radar, but not making any recommendations yet. We need to see how all of this plays out and just get more clarification on, does it roll in and turn into a retirement account? And now we're looking at age 59 and a half withdrawals. But it is a unique way for parents, grandparents to possibly start contributing to a child's account much earlier than they were previously having to wait for that earned income requirement.
Interesting, Tara. Thank
It
you.
is, yeah.
With that, we need to apologize, or would like to apologize to everyone who wanted us to go through the entire 1,000 pages. No, in all seriousness, we've tried to focus here on the things that would be impactful from individuals and couples. There's a lot more in the bill from businesses and beyond. We've tried to hit the things that would be most have most potential to be impactful to those of you on the call. We did want to kind of wrap up with some action items, and so have this list here. Just number one, they're reviewing modified adjusted gross income and deduction eligibility. And so in light of the new bill, going back and revisiting your tax situation, many of you, if you're our clients, we've gotten copies of your tax return and been able to go over that with you, but happy to do that if we have not. So that would be one thing to think about. The second item there is just thinking opportunity for 2025 through 2028. So there are some of those things we talked about that are in that window of time, whether it's deduction on vehicle interest or the taxation on tips and overtime. So some of those things are restricted to this window of time from 2025 to 2028. So just keeping that in mind, and there's the ability to take advantage of those things. Reviewing cash position. So this is something that we talk often with our clients about. We need to go back to this regularly. We need some money in cash and money market savings. But oftentimes for folks that tends to grow to be more than it needs to be. And it's been, there's been somewhat of a caveat to this point on that, because interest rates have been higher and we've had a much higher money market interest rate that can be earned, even, not there now, but for a time period, we were over 5% on money market. Now we've dropped down about a percentage point. So we're still a little over 4%, but it is important that we not accumulate more than we need in cash, especially as that money market rate is anticipated to continue to go down over time to a more reasonable level. So reviewing cash position is an important thing. Maintaining long-term outlook. So this is a key one. This is just a good long-term investing principle to keep perspective on things. It can be difficult. If there's one thing prevalent now more than ever, it's the ability for news headlines of the day to move the market one way or another for a day or for a week. And great example of that was just the beginning of April, when we had tariffs announced and the market really spun. It's kind of out of control for the first couple of weeks of April. We did see it slowly work its way back up over the last couple of weeks in April, but we ended the month, and I read something that was kind of highlighting this whole principle of long-term perspective and staying invested. And it was highlighting that May was the best month in the market from the S&P 500 standpoint, I think in 35 years,
That's right.
something to that effect. And so the point was being made that nobody had that on their bingo card as, hey, we're about to have the best month at the end of April. Nobody said that. And it wasn't necessarily probable, but it was possible. And that's why, those that stayed invested and long-term investors, as many of you are, have seen that over time, the benefits of staying invested over the long term.
Yeah, and if you wouldn't sell it when it was up, why in the world would you sell it when it went down, right? It seems counterintuitive, but the headlines feel bad, don't they?
They
And
do.
That's a good
question.
segue. Good segue, Greg.
It makes you feel bad and question your strategy, but I think the value we provide to our clients is in keeping you focused on your goals.
That's true. Yeah, so that brings up that next line item there, emotional versus strategic changes. So we don't want to react emotionally. If we were doing that, we would have sold out the second week in April, and then we would probably be still sitting in cash waiting for the best right time, right? It's very easy to pull the trigger on selling, difficult to time, and make the decision on getting back in. So but pulling back, looking at your overall goals, your overall situation, your overall financial plan. We build into our plans periods of ups and downs in the market. We know that the market is not going to go up 100% of the time. And so it's helpful to be able to return back to that plan and bring perspective, especially in times of market volatility. And another thing that's important as part of our process, and that's the last item there, is just rebalancing periodically. So if you've been our client for some time, or maybe you're a newer client, we've communicated to you that and maybe you've experienced that we do rebalance our portfolios periodically. And we did that lastly right before the tariff announcements at the beginning of April. So at the end of March, we had a pretty decent time period in the market up to that point. And while we didn't know that the volatility that occurred the first couple of weeks of April was going to happen, we did know that there was going to be tariffs, announced, and trade uncertainty. And so it's important that we strategically and periodically rebalance your accounts to bring them back to their risk targets. That is something we are going to be doing that over the next several days. We're going to be rebalancing our portfolios if you're a client, and we will be communicating with you on that. But basically, in light of what I've just kind of highlighted, like we had a volatile April, had the best month in May, and we've continued to have decent stock market returns, performance returns. And so valuations have crept up slightly. We feel like it's a prudent time for us to rebalance back to our targets. I mentioned interest rate expectations. We feel like we're positioned well from a fixed income standpoint. So in this case, we're looking at rebalancing as opposed to doing a lot of reallocating. Anything to add there?
No, I think that's good. Just part of our overall process and being prudent to take action and make decisions on behalf of our clients.
Yep. So that brings us to we always like to close our webinars with biblical wisdom and truth. And this verse today comes from Joshua 1:9. It says, "Have I not commanded you, be strong and courageous? Do not be frightened and do not be dismayed, for the Lord your God is with you wherever you go." And a little bit of background here. This is the Lord. He's speaking to Joshua, and the torch has been kind of handed off to him. And this is not just one time that he's encouraged with these words. It's multiple times as we read the text in Joshua. And even just before this, the verse before, it talks about it's not just the Lord being with you, but it's observing the Lord's commands, observing his word, being obedient to it. And so there's strength and courage that comes from walking with the Lord and him being with you, but also by having his word and seeking him in his word and obedience to it. And so just wanted to encourage all of you in that. It is a big part, our faith is a big part of our life and what drives us and what motivates us. So, and with that, we wanted to kind of wrap up. Apologies again, we went a little over the 30 minutes that Greg promised, but it was too much to fit into 30 minutes. So we thank you for joining us today. We are here to serve folks and to be a resource. So if you have questions, if we've touched on anything that you have additional questions about, happy to address those if you'll just reach out to us, or if you've got friends, family, loved ones, neighbors, co-workers who you think would benefit from a conversation with us, we'd be happy to schedule that and set that up. We enjoy helping folks, and that's what we're here to do. So we welcome that opportunity, and we'll continue on with what we do and allow you guys to focus on those things that are important to you. Our tagline is freedom to live inspired. So hopefully we are allowing you to take some off of your plate, but we'll gladly take it on ours and let you guys focus on other things. So with that, we appreciate your time today, and we will look forward to our next webinar a couple months from now.
See you guys.
Bye.
Bye.